Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike.
Mike Zlatnik, and today it is my pleasure and a privilege to welcome back Jeremy Roll. Hi, Jeremy.
Hey, how are you doing? Thanks for having me again. I appreciate it.
Thank you so much. You are a multiple times repeat guest. You had a lot of great wisdom on the last few episodes, so I'm delighted to have you back.
Yeah, absolutely. Looking forward to it, and I hope this is helpful for your listeners.
Yeah, I know it's going to be very helpful because you have a lot of wisdom. So before we do that, what's new and exciting in the world of Jeremy? What's going on?
Well, honestly, we're recording this end of year. I do books for my own books for my companies. I'm focused on that, and frankly, counting on the days for the winter break that my kids have, so which makes me have a break, and I'm very much looking forward to that. That's pretty much what's on my mind right now.
Yeah, that's great. We are entering holiday season, and I think we all could use a break. So that's the purpose of the holiday: spend some time with family and kind of wrap up the business for the year and plan for next year.
Yep.
All right, so we are recording this kind of in the middle of December, and just curious, what are your thoughts on the economy, real estate market? Where are we going? What's going on?
It's a great question. So I think from the economic perspective, from what I see right now, the Q4 projected GDP at the moment is still quite high. I think that's probably a big product. It's been actually a lot of big product in the last quarter as well, out of some military production of items that have been shipped overseas. But I think that there's still probably 3 to 6 months left of stimulus money that had been saved by consumers. It's kind of draining out. Some consumers don't have any left, and credit card spend is increasing pretty greatly, but some still do. And I think that's probably kind of bridging, what's going on at the moment as far as consumer spending. It appears as though most people believe we're going to have a recession next year, me included. I think that the recession is going to come about as a result of the lagged effects of the federal interest rate increases, Federal Reserve, in combination with the stimulus wearing down as far as the actual, savings that consumers had. So I'm anticipating a recession for next year. Nobody really knows how bad it's going to be or what it's going to look like. I can tell you that continuing jobless claims have gone up, I think, for 6 months in a row now. So it's kind of slowly happening, very slowly. And I think we're going to see, even though we've seen a ton of headlines so far, I think those headlines are going to continue and get worse probably next year. And obviously watching the Fed very closely to see what they do with interest rates. And from a real estate perspective, I've seen a good, depending on the asset class, but, take multifamily just because it's a lot of people tend to watch it. I've seen and heard, 15 to 20% of price adjustments so far. But I tell you, the one thing that I think not enough people are talking about that is the other possible shoe to drop on this is inflation during a time of a potential recession, which could lead to stagflation. And it could also lead to either flat revenues or declining revenues at properties alongside pretty substantial increase in expenses. And so I'll give you an example. I know if you're familiar with Ken McElroy. He's pretty well known. Sure. Yeah, he has a very big YouTube channel, owns, I think, a couple billion of multifamily with his investors. And I just watched a recent video of his about 2023. And one thing he said is his own internal budgets for his property show 0% revenue increase assumption and 7 to 10% expense increase assumption for his properties. And if he's actually wrong on the revenue side and it's lower, then you've got even a further negative NOI or a reduction in NOI. And so I think that investors are facing two challenges. One is cap rates that could continue to increase and multiples that are going down. At the same time, I think you have the possibility and distinct possibility during a recession, this is very common, for rents to potentially either go flat or go down and vacancies to go up. And then in this particular environment, you have the unusual situation of expenses continue to go up at a very high clip. That will probably come down over time with inflation, but I don't think it's necessarily going to match up right away. So that's what I see for 2023 as a big risk, which is why I'm continuing to be mostly on the sidelines, just watching to see what happens with this reset.
That's an interesting observation and a lot of great nuggets. I think your commentary on the recession makes a lot of sense. Everyone sort of in general is in agreement that 2023 is a year of real recession without clarity to the severity or when it's really going to hit. But that's a consensus of a lot of smart folks. What you just mentioned with Ken McElroy, point that we're going to see stagflation, that's an interesting news in essence, from the point of view that I haven't heard that the revenues will stagnate and go down. I've heard the growth will slow, but this is an extreme opinion that the rents may flatline or even reverse while expenses may pick up. That is pretty, I would say, significant observation, if I may say that.
Yeah, well, it's something I've been warning people of all year. And it's, at the beginning of this year in 2022, people could not visualize rents going down because they were going up at such a big clip that if a recession were to happen, they just couldn't picture rents actually going down or flat. Now, as rents have started to come down and the growth has started to come down, right? The growth, I shouldn't say rents, but the growth is coming down. I think people are now seeing how that could be possible because that's a typical recession playbook. And so for myself, I just always go with the typical recession playbook that I have to assume will happen just from a probability perspective and just wait and see what happens. And if I was wrong and rents continue to go up, no big deal. I just then redeploy money into a new cycle, right? So it's not a big deal for me personally as an investor, but I'm not surprised that he said that because I think he's just taking a typical recessionary playbook and, putting it into his budget.
Yeah, it makes sense. Kind of a high level, although this is not by any means a typical recession. We are dealing with a little bit unprecedented times. So the past models don't exactly pan out because this has never happened before. This change in the interest rates, this amount of stimulus, there's so many things that has never been seen in the history.
Yes.
The one thing that I kind of think about is that under normal recession, you have substantial unemployment, which we haven't seen yet, even though the headline layoffs have taken place, or at least hiring freezes. But we haven't seen large unemployment numbers yet. We're very far away from substantial unemployment. The second element, we're dealing with elevated interest rate environment, and people are not able to buy, so they're forced to rent. The substitution effect has been substantial, where many renters many homeowners have been discouraged by the high interest rate environment and forced into the renting environment. So seeing the rents turn negative would be a surprise to me. We have substantial housing shortage in the United States, which is still the fact. So I would be a little surprised, although I'm not questioning that theory. That is an extremely conservative position to take. However, how realistic it is in this environment to assume the rent's going to go down for the reason that the new supply is limited and the demand is still pretty healthy, and the substitution effect is creating more demand as long as the rates stay high. So
yeah, I think what you're saying makes sense, and I think that the way I see it is that in a typical recession, there's a domino effect that happens. There is people lose their jobs, and then they can't afford to rent the same unit. Now, either that means one of several things. They go back home and they go back, live home. They go and bunk up with somebody else, right? Or they downsize or reduce into a lower type of quality rental, lower cost. What's odd about this time, to your point, is the employment picture. And what's not clear is what's going to happen next year. And one fact that I don't often hear hardly ever, which is really fascinating, is I believe there are 4 million Americans, and I hope I have the number right, that are currently on disability due to long COVID. Okay, that's a big number. And if you're trying to figure out why the jobs, all these layoffs have happened, but yet we haven't seen unemployment rate tick up yet and all that, because those people are out of the market and are causing, some of the people that are out of market and are causing reduction in the availability of labor. And then you pile that onto the fact that there obviously been some early retirements by older people who were scared of COVID and don't want to go back because of COVID. And all of a sudden you have a bit of a different picture you're dealing with on the employment side, right? And so the real question to your point, Mike, is what is the employment picture going to look like next year? And will the typical domino effect happen? where we do see such a big reduction in the increase in the employment rate that that will impact housing, or will we not have that because of these other factors, which would make this very different and may help to support rent? So nobody knows yet, obviously.
Yeah, and a great point. A lot of people chose to exit the labor force. Call it COVID effect, going to disability versus choosing to retire early. That has taken place over the last few years. And that has created substantial labor shortage. Immigration policy has been obviously, COVID has slowed down immigration substantially. So other than the folks that have come over the border illegally, we haven't had legal immigration to the degree that we need to have. So that aside, we're going to have this problem for probably years to come. We're going to be short. And U.S. should certainly open up its, increase the green cards, increase the number of other legalized methods to increase immigration. But for now, we're going to be dealing with this problem. And that's that's a really good point that you have mentioned. And I'm trying to also ascertain the possibilities of what you mentioned is an extreme position. Again, Ken is a wise guy. He's a well-known. He's well-respected. But I would say it's an extreme position. No rent growth and a very substantial cost-based inflation. The cost-based inflation, and I'm hearing this from folks who are in the industry, who are constructing. They've indicated, at least that I've heard quite a bit of, that the construction price growth has slowed down, and in some instances the prices are reversing because demand has weakened. So I would normally expect also softening of the costs and the so this inflation versus stagflation versus some kind of severe recession. It's all tag of war right now.
Yeah, definitely not obvious. That is for sure.
So where you're sitting on sidelines with dollars, right? And you're a very prudent investor. Is that the right strategy now to slow down new investments and just sit on sidelines and wait, or continue? Obviously, there are some investment decisions based on the fact that we are late in 2022. It's still bonus depreciation year. People are investing into deals for other reasons. But if you are just taking a pure IRR, ROI type of a position and you're trying to pick and choose where your dollar is going to go, is it just better to sit and wait for a few more months and see where we are at? You also mentioned a very important point that you're seeing discounts on many properties anywhere from 10 to 20%, maybe 15 to 20%. I've seen the same. It's kind of interesting. Definitely it's transpired in commercial real estate. Many deals are being retraded. Discounts are being asked for all the time. And depending on the quality of asset, depending on the regional terms, discounts could be more or less what you mentioned. But on a forward basis, we're going to see even bigger discounts. The Fed has mentioned what it's mentioned, and its runway in the policy in the Fed's funds rate increases is probably they're going to push another 150 basis points. At that point, we're very close to eternal speed. Well, let's just call it that. The 10-year Treasury has shown stubbornness and said, "Wait a minute, we are not following the yield curve. The inverted yield curve is widening." The 10-year Treasury is indicating we're not going to see that kind of rapid inflation on a forward basis, so it's back down in the mid threes, maybe mid to high threes. So, what are you thinking? What's the best course of action as a prudent investor? Sit, take action, wait for remarkable deals. What do you think?
It's a great question, but there's so much to unpack there. Here's what I'll say to begin with. I believe there's 1,000 ways to invest. None of them are wrong, and everyone has to have the best personality fit for themselves. So I always tell people that I'm really ultra conservative, and I choose to sit on the sidelines when there's uncertainty because I look for predictability, because I invest in more predictable, lower risk cash flow, and I live off that cash flow. And so I'd rather wait 6 to 12 months, see what happens during this period. And if I missed out on the 6 to 12 months, I'm behind on inflation. But that's my personality. And so I tell people that I am not going to end up with the highest returns long term as a result of this. There are some people who say, I don't care if I invest in a property today, the price goes down another 10, 15%. I'm getting my cash flow. I think it'll do really well during a downturn. And then, I look for a 10-year fixed rate loan, just as an example. And in 10 years, there's going to be some mortgage pay down. There's going to be some appreciation, some inflation, and I'm going to be totally fine. I don't care if the property is going down. And frankly, I really think that person is going to do better than me long term. Okay. Like mathematically, but where it doesn't work for me personally is a personality fit. So that's my feedback on that, right? That's the likelihood. What I will say is that, and this is really, I've been talking to a lot of people about this recently because I'm trying to get my arms around it. So the question as an investor like myself, who's trying to determine when the right time to go back in, one of the things I'm looking at, one of the metrics is I expect positive leverage as an investor. And where I have a very hard time right now where the market is and where the cap rates are is that in leverage call is either flat negative or it's very slightly positive, the best case scenario, right? Commonly negative in the deals I'm seeing still. I should be commanding 100, 150 basis point spread in positive leverage when I invest as an equity investor. And I think that that's normal. And so we're not there at the moment. And so that begs the question, and I've been having a lot of discussions with sponsors about this, and they say, we cannot see prices going down another 10 or 20%. And I say, I cannot see myself investing in negative or flat leverage. Which is it going to be, right? And maybe something else will give because that's not the only parameters, right? Other things can change in those parameters, but everything else being equal, will equity investors demand a spread on the leverage? And if they do, that implies prices have to continue to go down, especially if interest rates go up. But I know it's hard for people to picture prices going down further because they say, who is going to sell at a 20, 30, 40% decrease from the top, right? Only people that have to, obviously. So it's an interesting debate at the moment. I want to get your take on it, Mike, because as an equity investor on my side of the table, I'm trying to figure out, are equity investors looking for that typical spread that you would normally want to get to justify the risk, right? And then there's the other question of, I'm doing a lot of laddering of treasuries, and I'm doing it in 3 or 4 month type increments, right? In terms of very short-term treasuries. And I bought some this week and I got 4.4 something percent, right? And if there isn't some type of premium in the year one cash flow that I'm getting from a multifamily deal because of either negative or flat leverage and a low cap rate, does that make sense, right? And I know actually I could tell you personally, I've been having conversations with other investors who are doing the same, and they're actually starting to look at it that way. They are saying, I want a premium for the risk above treasuries, which makes perfect sense. It's logical, on the return of my cash flow into a deal. And the cash flow isn't there yet. That implies that prices have to go down or something else has to change, interest rates, whatever it's going to be. So I'm really curious to get your take on this because I haven't spoken to enough equity investors to get a true sense as to whether people are thinking about it this way or not on the positive leverage side.
By the way, that's a brilliant point. So just to clarify, when you're referring to the spread, you're referring between the cap rate and the interest rate. So it's a negative.
Exactly. Yeah, exactly.
Yeah, that spread has turned negative for the most deals where folks wind up getting interest rates on the mortgage higher than the cap rate that they paid at the purchase. And that argument makes total sense if you were buying a performing stabilized asset. If you're buying a substantial value add, you can live
100%. Yeah, you're right.
We've been investing in deals with substantial value add where the average rent today is say $1,000, and upon completion of the value add in 4 years, we'll project the rent to be $1,400, heavily driven by major improvements in these units, right?
Right.
From that perspective, it doesn't even matter that you're buying at 5 cap now and you're borrowing at 6.5 rate, right? From that perspective, that negative 1.5% by the time you're done becomes substantial positive one. So that will be my first comment, that as long as it's a good value add deal and there's a strong ability to execute. So back to the things that you mentioned, this is a really critical point. Folks who can't execute the value add, they're going to fail on the value add. The deals can go sour from the point of view they're buying with negative leverage. And if they can't get the cash flow where they need to go, the deal may actually lose money, not make money. So something really important to keep in mind. The comments on your strategy with treasuries, I've heard that before from other really smart investors that taking essentially no risk. Treasuries are presumed to be risk-free. This is as low risk as it goes.
Right.
So buying treasuries, but the primary theory behind buying treasuries is the fact that you expect the interest rates to fall, right? So they're still climbing. They're still climbing in the short run. You may live with a little bit of that, but in
Yeah,
the
but you
long
can
run,
ladder it though.
they're
Like
gonna cycle
everybody I
down.
know, like sorry to interrupt you, but I'm laddering for that reason, and everybody I know is laddering to be really cautious.
Yeah,
So
you have to ladder because you don't know what's going to happen, right? So
yeah,
you get some 3 months, some 6 months, some 1 year paper, and from that perspective, that's the right strategy. But the smart money, and I was at another conference, and one of the really sharp investors there, his comment was exactly that. I want to buy the bonds with a lot of safety, a lot of downside protection, and basically speculating that in 2 to 3 years the rates will come back down. So the yield of 4% will be substantially enhanced by the appreciation of the principal. So that's the thesis behind that. It's a safe investment, an expectation of interest rates actually coming down. So I will absolutely applaud the strategy. It's a good strategy. It's a relatively safe strategy. So, and then the other point you said that investors in equity or the multifamily deals are speculating that they can get higher returns or higher risk-adjusted returns versus the treasuries, and that's yet to be seen. It's a weird time where you consider investing in the treasuries for years. That whole investment didn't look attractive enough, and now it's beginning to possibly look attractive, especially if you believe that the interest rates will cycle back down after, again, they'll peak probably at 2023 and then cycle back down in 24 and beyond.
Yeah.
So,
but you don't even have to have that approach necessarily. I know a lot of people do, but you can just buy short-term treasuries and lock in the yield for 3 months and cycle if you want to.
Correct. So 3-6 months. Again, the counter argument to that is what is the real inflation, right? So you are not really earning a positive return on in real dollars. Your rate of return is still theoretically negative because inflation is still reported way higher than what you're earning on the treasury.
Yeah. But the problem for someone like me who does tend to focus on more predictable, stabilized properties is that what you're suggesting is a value-add strategy still makes sense to try to counter the inflation, and then you end up with a higher yield. Then obviously you get that risk premium. Someone like me, there's not much of an alternative at the moment, right? And a lot of us are landing on the treasuries as the best alternative, not keeping up with inflation at all. But what it is doing is potentially setting us up to invest at better timing, depending on how this unfolds, like we talked about, depending on whether or not NOIs go negative or not, depending on whether or not cap rates continue to go up. Like there's a lot of factors, obviously. So we'll have to see.
Yeah, and I will absolutely acknowledge the fact that you're a conservative, more predictable investor, and that's a great place to be. And what we've done in our own deals and deal structuring, we've actually bifurcated common and preferred equity, giving the predictability of the preferred equity yield. So we've done a number of deals literally now that we just they're finishing up. We've created preferred equity with distribution yield of 8% and a pref of 16, with a higher safety and a higher predictability, and then let the common equity take all the depreciation because we're going to steal 100% bonus depreciation a year. So we've done this financial engineering to serve the needs of different folks, but it's kind of falls in your argument. How do you go get lower risk, more predictable return? Preferred equity is effectively the place to be versus the common, right? If you can do that, then effectively you created sort of goals similar to yours: lower risk, more predictability.
Yes.
But I have to say that what I'm seeing right now is that number of value-add projects from the past having run into some challenges with their value-add execution. And this is where the risk zone is. So the risk happens if you execute well and you can actually get those units renovated and leased, you'll do well. But if you can't execute value add well as an operator, you can run into trouble where the bank's beginning to squeeze equity investors. In other words, the banks are beginning to push on other covenants, not just the payment covenant, but the SCR and number of other financials that they want to see, forcing investors to bring in more reserves and more equity capital to reduce the risk for banks. This is one of the concerns that I have right now, that the projects that can't stabilize fast enough or run into some kind of delays or issues. they may be pressured into distress sales, and that's where you're going to see distress.
Well, I think
Normal
that
operators just not going to discount 20%. But if it's a distress sale because the banks are squeezing them, then you're going to see those discounted transactions. That's how I feel the market is going to transact next year. Is bank pressure will force some folks to sell.
I think you have to also layer in the rate caps that people. I mean, I know a real operator who spent, I think it was like, was it 100? I don't want to get the numbers wrong, but it was like just $15,000 times 2 for a rate cap that is now $4 million next year at the current structure, and that's a large property. Okay, it's multifamily, but I've been hearing all stories about the rate caps and all this, and it's going to be interesting to see what happens with that too.
Oh, it's a gigantic problem. I just came talking to 2 people with exactly this problem. The banks are requiring additional capital escrows to buy rate caps, and the capital now is substantially higher than what it was when they entered into those deals, the bridge loans. It's a major problem from the point of view that it requires a lot of basically capital to continue to preserve the interest rate from whatever it was at the entry point, and it's not clear what's going to happen. So this interest rate increase has been incredibly painful if someone didn't buy a long rate cap. Yeah.
What I'm finding though, and the people I'm talking to, most people bought either 2-year, 3-year, most commonly 2-year, and
now they're running out. And it's what you just mentioned is the problem we've seen on a couple of deals, and it's not an easy problem to solve. It's basically requires more liquidity, and you have to execute better. If you don't execute better, that rate cap is a wasted money, right? I mean, you just bought yourself more insurance, but it's a money thrown out the window. Literally, it's a requirement. Otherwise, the bank's gonna call a technical default on you.
Yeah. So we'll see what happens with that too. Obviously, that could change. Rates change, that'll change. So we'll have to see.
I appreciate that. I think we covered some really great points, and there's going to be a lot more pain. The Fed doesn't even. Well, the Fed policy has long and variable legs, and it just takes a long time to figure out all these ramifications of or everything the Fed has done so far, what exactly problems they're going to cause. And they're already causing a series of problems. And it's by design to fight inflation, but they will cause a lot of asset deflation as a result of their policy. And we just have to be more opportunistic next year, much more careful. And everything you said, being a conservative investor might keep you and other folks on sidelines until you see more predictability. For now, we don't know what's the terminal rate. So anyway, we're running out of time. Any final comments? Any other, how would folks get a hold of you? Just if they wanted to, I don't know, communicate, reach out.
Yeah, absolutely. No, and thanks for having me. Thanks for everyone who's listened to this here. I hope it was helpful for everybody. Easiest way to reach me is through my email, which is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com.
Thank you, Jeremy. I appreciate your wisdom. Love having you on the podcast again. We covered some really phenomenal topics. We have to do probably another episode soon enough. And thank you so much.
Yeah, thanks for having me. I always love our conversation. So thanks for having me again.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.